Good day to everyone. Good day to our accounting department, and also good day to our professor, Sir Mark Espirito. Hope all of you are safe and sound during this quarantine, this enhanced community quarantine. For our final output, the accounting department decided that we'll just create a online video lecture. So for our assigned topic, we were assigned to do formation of partnership with initial statement of financial position. So first, before I start, I'll introduce first my group mates. First, this is me, Hesed Carino, and I'll be discussing the introduction part on the formation of partnership. I'll be discussing the article and how to create a sole proprietorship, how to form a partnership, and how to journalize the investments of each partner in the partnership formation. Second is James Estrada. He will be discussing to you uh, the adjustments needed when a partnership is formed, the adjustments in the trial balance per capital, the agreement of investments of each capital. Last but not the least is Pierre Lopez. He will be discussing to you the initial statements of financial position of the partnership. So now, let's now start on the introduction of formation of partnership. First is the articles of co-partnership, a contract that forms an agreement among business partners to pool labor and capital and share in profit, loss, and liability. Such written document governs the formation, operation, and dissolution of the partnership. So, there's an article about co-partnership and which states that when we're gonna enter into a partnership formation, gonna we're gonna need a written document, which is a contract, so that we can know how will this partner operate, how will this partner uh, will be formed, and how will this partner be terminated. So that's the essence of article co-partnership. What about partnership? What are the movements in equity? Here in partnership, accounting on a per partner basis. Movements in the equity accounts are almost similar except that profits and losses are distributed and shared among with the partners in adherence to the partnership agreement. So all of the movements in the partnership formations are all the same. The one thing that's different is that their profit sharing and their loss. It will depend on the agreement on their contract if they will share profits equally and they will share loss equally. It should be stated in the contract because that's how the partnership will run. So there are two ways on how to form our partnership. I'll just tell you there's two ways and some examples will be given later on by my partner Pierre Lopez. So first is starting a business, two or more partners form a partnership for the first time. Second is sole proprietorship business converted into a partnership. A. An existing sole proprietorship business and a person without existing business. B. Two or more existing sole proprietorship businesses combine their resources. So I'll no longer elaborate more on this because my partner Pierre will be the one to elaborate on these things later on. Let's go to some examples. Cash contribution. On February 1, 2020, Coco Martin and Boy Abunda formed a partnership by contributing 10 million each. Profits and loss will be shared equally. So first, how do we journalize this? We write the date, which is February 1, 2020, the account's description, which is cash. We're journalizing here the formation, the partnership already. So the debit is 20 million. And then the credit is Coco's capital and Abunda's capital, each with 10 million. Then there should be a description, initial investments by each partner. Another cash contribution by Hesed and Matthew. Like before, they contributed 5 million each, which states that they will share profits and loss equally. So cash 10 million, they both invested 5 million, so their capital will be 5 million. How about this one? On March 30, 2013, James and John formed a partnership by contributing 100,000 each. In addition, addition, James also invested furniture and fixture costing 50,000 but with an agreed value of 25,000. Profits and loss will be shared equally. Now here it's a non-cash contribution. So we write cash 200,000. Furniture and fixtures, what's the agreed value? It's 25,000. Then James' capital will be 125 and John's capital will be 100,000. Cash and non-cash contribution with liabilities. On March 30, James and John formed a partnership by contributing 100,000 each, and in addition, James also invested furniture and fixtures costing 50,000 but with an agreed value of 25. Moreover, John invested land with an agreed value of 100,000 subject to unpaid mortgage 20,000. Profits and loss will be shared equally. Now, here the cash is 200,000 and then the furniture fixtures is 25,000. Here the land, it's subject to with a mortgage payable. But since profits and sharing is to be, profits and loss will be shared equally. So the mortgage payable will be shouldered by the partnership. So we will also include it in the journalizing. So the mortgage payable is 20,000, James capital 125, John's capital is 200,000. So that's how we journalize the formation of the contribution or the investments of each partner. So for the part two, adjusting trial balance of each partner will be explained to you by my partner, James Estrada.
Hello, I am James Brian D. Estrada, and I'm here to explain to you the part 2 of the partnership formation, which is the adjusting trial balance of each partner. As you can see, the table is composed of the contribution of each partner, which is partner A and partner B. In the books of partner A, he contributed cash amounting 200,000 pesos, has accounts receivable of 100,000 pesos, an inventory of 160,000 pesos, notes payable of 120,000 pesos, and a capital of 340,000 pesos. On the other hand, in the books of Partner B, contributed land and building with 100,000 pesos and 240,000 pesos value respectively. Overall, the Partner B's capital is 340,000 pesos. Let's proceed to the additional information of the adjusting trial balance of each partner. The adjustments should be done in order to know the balances of each partner. So, number one, included in accounts receivable is an account amounting to 40,000 pesos, which is deemed uncollectible. So, in the adjustments, number one, there will be an allowance for bad debts amounting to 40,000 pesos. Number two, the agreed value of the inventory is 180,000 pesos. So, in the adjustments, number two, the inventory's agreed value would be 180,000 pesos from 160,000 pesos. Number three, an unpaid mortgage of 20,000 on the land is assumed by the partnership. So the adjustment would be there will be a liability account for the unpaid mortgage of the land amounting 20,000 pesos that is assumed by the partnership. So number 4. The building is under depreciated by 50,000 pesos. So the adjustment would be the building is under depreciated by 50,000 pesos, which will be deducted from the previous amount of 240,000 pesos. Number 5. The building has an unpaid mortgage amounting to 30,000 pesos, but the mortgage is not assumed by the partnership. B agreed to settle the mortgage using his personal funds. So the adjustment, since the unpaid mortgage is not assumed by the partnership, this will be not included in the adjustments because of B agreed to settle it using his personal funds, and there will be no adjustment to it. 6. The note payable is stated at face value. A proper valuation requires the recognition of the 30,000 pesos discount on the note payable. The adjustment, there will be 30,000 pesos discount on the note payable of partner A. So this will be deducted from the previous amount, which is 120,000 pesos. These are the adjusted balances in the partner's capital accounts. In A's books, cash has 200,000 pesos, accounts receivable has 100,000 pesos, allowance for bad debts of 40,000 pesos, an inventory of 180,000 pesos, a notes payable of 90,000 pesos. The overall A's capital is 350,000 pesos. In B's adjusted books, land has 100,000 pesos in amount, building becomes 190,000 pesos, has a mortgage payable of 120,000 pesos, and the total B's capital is 270,000 pesos. Overall, this is how you do the adjusting trial balance of each partner in the partnership formation. On the next slide, it will be discussed by Pierre Lopez, the financial statements of partnership formation.
Hi, I'm Pierre Lopez and I will be teaching you financial statements for the formation of partnership business. So first, I want to show you the learning objectives of informing the financial statements of a partnership. First is understand the types of partnership formation and making the statement of financial position for sole proprietorship to partnership and for two sole proprietorships to partnership. In converting sole proprietorship to partnership, there are three steps that we follow according to the book. Step 1, revaluing assets owned, liabilities owed, and capital of sole proprietorship. Step 1 is for making adjustments, which was taught to you by James, and this is to adjust for the values that was proposed by each partners in before making the partnership business. Second step is close existing books of sole proprietorship. This is to make way for the new books that will be opened for the partnership business. Third step is record investment of all partners. This is where the record of transactions which was contributed by each partner. For the first problem, I got this from the book. I just changed the names. And for the first problem is sole proprietorship to partnership. Hesed has successfully operated a law office for a couple of years now. Hesed wished to expand the business but does not have the needed additional capital. Hesed then enters into an agreement with James and Pierre to form a partnership business with the name of HJP Law Office. The partners agreed that after the revaluation of certain assets, Hesed is to invest his business in the partnership and an additional cash investment from his personal assets with an amount of 550,000. James is to contribute computers, printers, and fax machines, which have a total fair market value amounting to 250,000 pesos. Office supplies amounting to 10,000 and cash investment equal to Hesed's cash investment. Pierre is to invest a new car costing 550,000 pesos. Here we can see the agreed revaluation upon by the partners. First is estimated uncollectible accounts increased to 10,000 pesos. Next is office supplies revalued to 6,000 pesos. C. The accumulated depreciation for office equipment and furniture and fixture should be increased to 10,000 and 3,000 respectively. So for the first one, we would increase uncollectible accounts to 10,000. So that's allowance for doubtful accounts should be added by 5,000 pesos in order to be 10,000 pesos, which was the agreed revaluation upon by the partners. while office supplies revalued to 6,000, then office supplies, which is amounting to 8,000, should be decreased by 2,000. And for C, the accumulated depreciation for office equipment and furniture and fixture. So for the accumulated debt of office equipment should be 10,000, which is increased by 2,000, while for the accumulated debt furniture and fixture should increase by 1,000 to be 3,000. So here are the adjustments that was made, which is the first step in making the statement of financial position, or the first step in converting a sole proprietorship to a partnership. So here we made an adjustment of adding 5,000, which we placed it in the credit side, while Joseph Capital is at the debit side. The same for the next is Joseph Capital for debit 2,000, office supplies 2,000 credit, Joseph Capital 2,000 debit, accumulated debt office 2,000 credit, Joseph Capital 1,000 debit, and accumulated debt furniture and fixture credit 1,000. For the second step is we are going to close the accounts of Hesed, the sole proprietor. So what we did is allowance for doubtful accounts, accumulated debt office equipment, accumulated debt furniture and fixture, accounts payable, Joseph Capital that came from the credit side are put into the debit side in order to close it. And cash, accounts receivable, notes receivable, office supplies, office equipment, furniture and fixture are all transferred to the credit side to close these accounts to make way for the new books of the partnership business. For step 3, record investment of all partners. This is to show Hesed's contribution and James' contribution and Pierre's contribution, which are all the partners. So we can see that they have the same contribution, which is 550,000. For each GP law office, this is the statement of financial position. So first, we would tackle the assets, which is cash of 685,000. We got 685,000 from the cash contribution of Hesed, which is 395,000, and James's 290,000 cash contribution. While for trade receivables, which is a note, we got it from accounts receivable of 70,000, notes receivable of 20,000, minus the allowance for doubtful accounts of 10,000, which will be equal to 80,000. Office supplies is from the contribution of Hesed, which is 6,000 of office supplies, and the contribution of James, which is 10,000 worth of office supplies, and will be equal to 16,000. We get 781,000 for the current assets. Now, moving on to the non-current assets, plant, property, and equipment of 887,000 is from the contribution of Hesed of office equipment 70,000 and furniture and fixture of 17,000, plus the contribution of James, which is 250,000 worth of office equipment, and the contribution of Pierre, which is a transportation equipment worth 550,000, which will be equal to 887,000. from there, we will get the total assets of 1,668,000. Now, going to the liabilities and partners' equity, the current liabilities is accounts payable of 18,000, which is from the investment of Hesed, and the partners' equity, which is equal to all partners, is 550,000 each, which will be equal to 1,650,000. And if you add 1,650,000 to 18,000, it will be equal to 1,668,000. And that's the statement of financial position of HJP Law Office. For the next problem is two sole proprietorships, two partnership. So this is also from the book, and I didn't change the names. So Romy and Argem, proprietorships of Romy Engineering Services and Argem Property Management Services, respectively, agreed to form a partnership called Rogem Property Consulting. The soon-to-be formed partnership shall take over assets of the business and assume liabilities of their companies. So the following adjustments are: first is the allowance of bad debts should be established at an amount equal to 10% of accounts receivable. So the next is the furniture and equipment of both firms are ascertained to be 20% depreciated. Interest payable of 1,000 already accrued on the note of Argem has not been recorded. Office supplies shall be valued at 90% of its actual cost. Argem is to invest additional cash so that she will have a 60% interest in the new firm. So we can see here is the trial balance of Romy and Argem. So that's where we would base all our adjustments of the revaluing of the accounts. So for the first step, we would revalue the assets owned, liabilities owed, and capital of Romy. So here, Romy capital 1.5, allowance for bad debts 1.5. So that's the 10% of the accounts receivable of Romy. And Romy capital and accumulated debt, furniture and fixture of 400. Accumulated depreciation, office equipment, and Romy capital of 3,000. So Romy capital and office supplies of 700. The next step would be closing the existing books of Romy. So like what we did, we transferred all the accounts of the on the from the credit side to the debit side, and all the accounts to the debit side was transferred to the credit side to close the accounts. So for the books of Argem, the adjustments was Argem capital 1.5 debit, allowance for bad debts 1.5 credit. The next is accumulated debt office is 2.4 debit, and Argem capital of 2.4 credit. Argem capital of 400 debit. Accumulated depreciation, furniture and fixture 400 credit, and Argem capital 1,000 debit. Interest payable 1,000 credit. Argem capital 1.4 debit, and office supplies of 1.4 credit. So the next is we close again the existing books of Argem to make way for the new set of partnership books. So the new set of partnership books is where we would base our statement of financial position for the partnership. So after doing the first two steps of revaluing and then closing for each partner, the most important is the recording of the investment of all partners in the new set of partnership books. This is where we would get the joint joint values of the accounts of Romy and Arjem. Now for the statement of financial position of Rogem Property Consulting. First, we would go to the current assets of the statement of financial position. So this is where we would start for current assets is cash of 223,500. We got 223,500 from the cash investment of Romy, which is 46,000, and from the cash investment of Argem, which is 177,500, which is equal to 223,500. Now, for the investments in trading securities, 21,000 is from Argem, which is from the financial assets at fair value through profit or loss. So it is as is. Now, moving on, trade receivables is the first note for the statement of financial position. Trade receivables have accounts receivable of 110,000 less than less to allowance for doubtful accounts of 11,000, which will be equal to 99,000 for our trade receivables. Now for our prepaid expense, which is the second note, the prepaid expense is from the agreed valuation of the partners, where office supplies shall be valued at 90% of its actual cost. So the prepaid expense would be office supplies expense of 6,300, which is the 90% cost of the cost, and office supplies expense of 12,600 from Orgem's office supplies. So if you add 12,600 to 6,300, it would be equal to 18,900. Now for our current assets, the total current assets is 362,400. Moving on, for our non-current assets, plant, property, and equipment is the third note, where office equipment of 166,400 is added to the furniture and fixture of 75,200, which is equal to 241,600. Now, our non-current assets is 241,600, and added to the current assets of 362,400, it would be equal to 604,000, which is our total assets. For our liabilities and partners' equity, current liabilities have trade and other payables, which is the fourth note, where notes payable of 10,000 is added to the accounts payable of 12,000, and also added to interest payable of 1,000, which will be equal to 43,000. Now for our partners' equity, our Gem Capital has 336,600 and Romy Capital of 224,400. So if you're wondering why the capital of both partners are not equal, it's because they didn't have an agreement of they would be having an equal contribution to the partnership business. So if you add the capital, it would be 561,000, and added to 43,000, we would get the total liabilities and partners equity of 604,000. So, this is the statement of financial position of Rogem Property Consulting.
So, thank you everyone for listening to our online lecture. Hope you all enjoyed and always take care of yourself and there's life after this quarantine. And thank you and God bless you all.